Welcome to Personal Finance Declutter. Before we dive right into it, let me explain the context of this conversation. Before the question whether one needs to pay off the mortgage or to invest, there are a few things that need to be established prior. The assumption I'm making is that there are no other outstanding debts, as in there is no credit card debt, student loan debt, or personal loan debt. The only debt you have is the mortgage. The second assumption I'm making is that you're maxing out your 401k. The money you have left over after maxing out your 401k and paying off all your bills is what we need to consider. There are a few specific reasons for these assumptions. I don't think it's wise to explore whether you need to invest when you have other outstanding debts that have higher rate of interest. Typically, credit card loans, personal loans, etc. have a higher rate of interest, and they automatically rule out the investment option because the interest rate is usually higher than the stock market returns. So with that said, let's get into it. This is a question that I've personally struggled myself, and I've had to form a solid thought process to convince myself that I'm following the right path. In a perfectly logical world where the mortgage interest rates are around 3 or 4% and the stock market returns are around 7%, it always makes sense to invest the extra money into the stock market because you'll be gaining 3 to 4% on top of what you'll be paying in mortgage interest. So you won't miss out on the opportunity of the stock market, and you won't default on your mortgage payments either. Unfortunately, we don't live in a perfectly logical world, and our world is really imperfect. The stock market returns are not guaranteed, but the mortgage interest rates are. By that I mean the mortgage interest rates are not tied to the stock market returns. Whether the stock market does better or worse, you have to pay your mortgage interest rates. Just because the stock market tanked the previous year, your mortgage rates are not going to go down. The historical trends point out to a 7% rate of return for stock market. But the historical performance is not a guarantee for future performance. Nobody really knows what will happen in future because the stock market is usually tied to the state of the economy. Because we can't predict the future of the economy, we can't predict the future of the stock market. The second thing is purely emotional. Having a paid off house is a really nice feeling. Mortgage can cause a lot of stress for a lot of people, and living a stress-free life is a really good thing and can increase your productivity and your life outlook. This is why, although on the surface it seems like a simple enough question to answer, when you dig a little deeper, it becomes a more complicated question to answer. Personally, for me, I wanted to pay off my mortgage as soon as I could, but then I thought about the opportunity cost of not investing in the stock market when the stock market was doing so well. So this is what I decided to do that helped me overcome the anxiety of having a mortgage and fear of missing out on the stock market growth. As stated in my assumptions, I don't have any debt except my mortgage debt. So we have a 15-year mortgage and we make regular mortgage payment, and any extra money that I have left, instead of putting that into the mortgage, I've been putting that in a stock brokerage account and investing that money in a total market-based index fund with low cost. My goal was to reach the outstanding mortgage amount plus the 10% cushion. Why 10%? That's where I feel comfortable that I can invest the extra money instead of paying the mortgage. I'm using this part of the brokerage account exclusively to offset the complete mortgage cost in case our employment status changes or there's a severe drop in the market. I'm able to pay off my mortgage quickly. Although they say that you shouldn't withdraw money when the market goes down, at the same time I have to feel comfortable that I'm not creating a risk by not paying off the mortgage in a bad economic time that might have other implications such as foreclosure and mortgage default. So that's my approach to balancing the risk of having a mortgage and investing in the market so that I don't miss on the opportunity of the stock market. You had to weigh the scenario for yourself to see where you feel comfortable and what's more important to you, whether having the peace of mind of not having a mortgage, or you're more worried that you'll miss out on the opportunity by not investing in the stock market, and make the decision objectively based on where you feel comfortable and your financial situation. If you like this video, go ahead and hit that thumbs up button and leave your thoughts in the comment section below. If you like this video, please subscribe to me on this channel, as I plan to create similar videos in personal finance, financial independence, and financial minimalism.